Here we are now at Miscellaneous Investments, the final unit in the first chapter on securities. And we're first going to talk about REITs, Real Estate Investment Trusts. Now, these may look sort of like the open and closed-end funds that we have previously discussed, but they're quite different. Whereas open and closed-end funds are buying stocks and bonds and other securities, real estate investment trusts are dealing in real estate themselves, which as a whole is not going to be considered a security. But there are three types. They could be a private REIT. That is one that is exempt from SEC registration, and they don't trade on national exchanges. One of the things that we have to understand when securities don't trade on national exchanges, when there is not an active secondary market, they're going to have something called liquidity risk. That's the ability to actually sell the investment quickly for what it's worth. If you buy stock and you lose money, but you still want to get your money out, what's left, you can do it like that. But if you can imagine with most real estate, if you buy a house and it goes down in value, you may not be able to get that market value, even the lower market value, quickly. Private REITs are generally sold to institutional investors. We're going to discuss them more later, but basically those are big corporate entities with at least $50 million to invest and under investment. So they're ones that generally don't need as much disclosure. They're considered to be much more sophisticated, so they don't need all of the warnings and disclosures that we need for normal retail investors. The REIT could also be a registered but not listed REIT. This is one that doesn't trade on exchanges but are registered. They are available to more retail clients, so they do have more disclosures than the private REITs. The retail clients are the ones that need protection. As soon as retail clients can buy something, disclosures and warnings are going to be needed. The REIT could also be listed. This is a REIT that is listed on exchanges. It actively trades on exchanges. It's not then going to have the same liquidity problems that other REITs that don't have an active secondary market might have. There are always people who are going to be willing to buy and sell these, so even if you wanted to get your money out, you could reasonably quickly. How a REIT might make money? Well, a REIT might make money as an equity REIT. That is one that acquires, manages, builds, renovates, and sells real estate. They generate income either from rent, similar things like that, or since they're buying and selling real estate, maybe simply from appreciation. Maybe they're just going and flipping houses. That's what this REIT does, is it goes and flips houses. It acquires, it then manages the real estate, it builds on it, it renovates it, and then sells it for a profit. The REIT could be a mortgage REIT. That's where they lend money to real estate buyers, or they purchase mortgages from mortgage brokers. They generate income from the mortgage loan interest. They could also do both. A hybrid REIT, where they're a combination of equity and mortgage, where they're both managing, acquiring, and renovating along with selling real estate, and they are lending the money to generate it. Next time you go to a mall, a strip mall, something like that, look for a plaque. I know at my local indoor mall there is a plaque that says PA REIT. Pennsylvania Real Estate Investment Trust is the name of the REIT that runs the mall. They get their money from the rent of the stores that are paying to be in the mall. We discussed about the regulated investment companies that follow that subchapter M, the pipeline conduit theory. REITs work the same way. If they're passing on at least 90% of their income, the REIT itself is not going to be taxed. Direct partnership programs, DPPs. These are a limited partnership usually. They don't have to be, but usually a limited partnership. That is where the investment is managed by others, in this case the general partner. There's limited liability. In a limited partnership, limited liability exists. That's the whole idea. The most you can lose is what you invest. The general partners do not have limited liability. Only the limited partners have limited liability. There's a flow through of income and losses. When the DPP makes money or loses money, it directly flows through to the investors. That's the difference between the DPP and a REIT. REITs don't need that direct flow through. DPPs do. So they can be used as a tax offset in certain ways. But there's high liquidity risk. The sale generally will require the general partner's approval. If the general partner says you can't sell, you can't sell. So it's completely illiquid if the general partner says you can't get your money out. But they can be organized, as I said, normally as a limited partnership, but they could be a subchapter S corporation or even a general partnership. Continuing, there's the pass-through tax treatment. The business doesn't directly pay any of the tax. The tax passes through the business directly to the investors. DPPs are unlisted. They don't trade on exchanges. So there are serious liquidity problems. They are generally illiquid. Can be hard to sell. As I said, they're not actively traded, and you may actually need someone else's permission to even sell it. It's not only trying to find a market, you may not have permission to sell it. If the general partner says you can't sell it, you can't sell it. Hedge funds, very high risk. They invest in derivatives. Their goal is to make a profit in all market conditions. That is, there are three market conditions. The market's going up, the market's staying flat, the market's going down. Up, down, flat, down. One of them is pretty easy to make money. In an up market, it's easy to make money. Go and buy something and wait, and you'll make money. It's easy. The problem is in a flat or a down market making money, and that's where the derivatives, the puts, the calls, potentially some other complicated things that you don't need to know about, but hedge funds do. They do invest in them. They are generally illiquid. There's a lock-in, limited trading opportunities. You need the partner's permission. You need the fund manager's permission. Partners can lock the fund with no withdrawals. One of my favorite movies in dealing with investment world is a movie called The Big Short. In that movie, there's a character named Michael Barry. It's based on a true story. There is a real Michael Barry, played by Christian Bale, or as I always think of it, it's Batman. But what he did in one of the scenes is he locked the fund. He sent an email to everyone in the fund and said, you cannot withdraw anymore. I am locking the fund, no withdrawals. And there were a whole bunch of email responses, lawsuit threats, and all that. But he could, as the fund manager, say, no withdrawals. And he did. It's usually going to have very high fees, usually high minimum investments, $250,000, maybe $500,000. It's usually structured as a partnership, a limited partnership. And it's not usually registered. The manager is usually registered, but the fund itself isn't. Hedge funds are not something most people that are watching this are ever going to sell. They certainly require at least a Series 7, and they are for very, very high net worth individuals. If you have high net worth clients, it might be something to look at, but again, they are very, very risky and can be very, very complicated. Exchange traded products. Exchange-traded funds. They represent ownership in the underlying portfolio of stocks, bonds, or commodities. Exchange-traded funds are very, very, very similar to closed-end funds. Their exact difference, ETFs are a little more transparent. They've got some slight differences. I'm going to put some additional resources below that go into it that likely aren't tested. No one has ever heard that question of what is the difference between an ETF and a closed-end fund? Because that's a trickier question. But if you're given a question about ETFs, think of it as a closed-end fund, and chances are you're going to be able to answer the question. They're very, very similar in the way they generally are talked about. But there's also an exchange-traded note. This is issued as a senior debt. They are unsecured, a senior debenture in this case. The issuer promises to pay the ETN holder, the exchange-traded note holder, the return on some index over a certain period of time, and the return of the principal of the investment at maturity. So the return, the rate of return, is based on some index. If the index does well, if the index does badly, it could affect the value of these ETNs. There are lower fees, though, when you're dealing with the exchange-traded products as opposed to the direct managed products like closed-end funds and mutual funds. Closed-end funds and ETFs, the other difference is ETFs are generally a little cheaper. But they are very similar. ETFs and closed-end funds are very, very similar. Asset-backed securities. Primarily talking about, in this case, about collateralized mortgage or debt obligations. That's CMO for the mortgage obligation, CDO for the debt obligation. They're unlikely to be the correct answer unless the word tranche or prepayment risk are mentioned. Then all of a sudden they may be the correct answer. But the interest on mortgage or some other debt are used to pay the owners of the CMO and CDO. That's basically what they are. And again, if you watch the movie The Big Short, they talk about this. If you remember the crash in 2008, when they talk about toxic mortgages and toxic debt. Yeah, that's what they're talking about, these CMOs and CDOs. Active versus passive management. Active management is going to have higher fees. Most mutual funds that we deal with are actively managed. They're trying to time the market to some degree. There's professional advice. There's commissions for the professionals to advise. You're paying someone to talk to you. You're paying for their advice. Could be very responsive to changes in the economy, though. Passive management has lower fees. The idea of invest and forget. It could be professionally chosen, but not actively managed. It won't be as responsive to changes in the economy, but it is lower fees. So depending on what the client wants, you may be able to do something here. Generally, most of us aren't going to really be doing much with the passive management because that's going to require most likely, at the very least, management accounts, which is the Series 65 license or the Series 7 license to be able to sell ETFs and closed-end funds. Series 6 reps are only going to be able to sell mutual funds and closed-end funds at initial offering, but we'll get to that later. But active is going to have higher fees, so trying to time the market or at least be responsive to the economy. And passive is going to have lower fees, invest and forget, buy and hold strategies. That brings us to the end of this unit, which happens to be the end of this chapter. Make sure you go through and you look back at all of these videos and any of the other resources that are provided on any of the topics. If you have any questions or concerns, please reach out to me. My email is brian@thesecuritiesguys.guru. If you've ever reached out to me, you know I am very responsive. I want to help people. I want to get you guys through. So if there's something I can do to make this chapter or any of these units better, let me know. I will be glad to try and make additional pictures or additional posts or writings or things like that. But do make sure you review all of Chapter 1. It is an important and large chapter. And I will see you in Chapter 2.